All right, welcome back. The markets are erasing some of the earlier losses. They actually briefly turned positive in a volatile last trading day of this holiday-shortened trading week. This is after Iranian state media reported that Iran is working with Oman on a protocol for ships passing through the Strait of Hormuz. For more on how to invest with all of this global turmoil and uncertainty is Ryan Dietrich, the chief market strategist over at the Carson Group, joins us here on set. Thank you for making the trip here to see us this afternoon.
No, honored to be in your city. It's always fun, Don.
All right.
So thank you for having me.
So, Ryan, we just showed the chart of the Dow on an intraday basis. We kind of saw that little tiny green peak in the late morning trading session, but we are well off. We were down about 670 points at the lows for the Dow. What do you attribute this kind of intraday volatility to when we thought that the markets were going to be in pure sell-off mode to start the day?
It's a nice change because I guess this is potentially going to be the 10th down Thursday in a row, the most negative Thursdays ever. There's some randomness to that, but this week's kind of what we've seen. You have early optimism on, okay, the war is going to be over, and then by the time you get later in the week, you get hard selling. But it is interesting. We've had this big reversal. You look at, I love market sentiment, right? So much hedging. I know you've had a lot of guests talk about this. Massive puts, the skews have been one way, lots of shorts. It's like this real slow motion. It's not a crash, but like a slow motion crash because everyone's predicting it. And then the market has a funny way of not doing that. One more quick one. The last 3 weeks in a row now, we've seen potentially less new lows on the New York Stock Exchange 3 weeks in a row. So the market's going down, yes, but less stocks going down. I think that's a glass half full type of thing to look at.
That skew, though, that you mentioned has been talked about by a number of folks that I've spoken to and even people that we've seen on our air over the course of the past 3 weeks. But it makes sense, right? If you are long the market in times of geopolitical uncertainty, you will pay relatively higher prices for downside protection as opposed to upside protection. That skew moves more towards the put pricing side of things. But we've learned lessons about just how shallow or deep some of these market moves can go. Whether you believe it's justified or not, the markets seem to want to buy dips. Is that something that we can see continuing over the course of this? Or is this a scenario where you have to say, if the war escalates, maybe this does become that deeper pullback that people have been waiting for?
No, great question there. I know I sent a couple charts. One of them is earnings. The other is profit margins, right? I mean, the reality, Dom, this year, S&P 500 forward earnings are up 7%, okay? So that's a lot. Market's down ballpark 5, 6, 7%. Profit margins hitting all-time highs. And we understand the worries, we understand the concerns. But at the end of the day, if corporate America stays strong, the labor market, which, hey, we've had some okay labor market news. Look at claims this morning. Again, pretty good. You know, the economy's not going into recession. We're not minimizing, again, what's happening here. But with all this negativity, it feels a lot like a year ago. We had all that negativity, and then we got through it. The market's not about good or bad. It's about better or worse. And with all this stuff priced in, we're optimistic that we're going to have probably some good news, maybe on the economic front, starting real soon with earnings, which, again, have been really strong so far this year.